there. So tonight, we're going to be talking about really 5 key strategies around how to maximize your Social Security benefits. Now, the agenda is framed around the questions that maybe piqued your interest in why you wanted to sign up and attend this. So first of all, how are your Social Security benefits determined? What goes into that? Secondly, what are the rules for when you can claim Social Security? And as you may know, you can claim at your full retirement age. You could claim early if you want. There's penalties that go along with that, and we'll go through the details of that. There's also the ability to delay claiming your Social Security benefits and earn a higher benefit through credits that are provided. We're going to take a look at how to estimate those. We'll take a look at the rules around how spousal benefits work and survivor benefits, and also in instances of divorce, how divorced spousal benefits work and divorced survivor benefits work. And then we'll touch on an outlook for what is in store for Social Security going forward. So getting started, probably the best way to figure out what a good estimate of your Social Security benefits will be is from the Social Security Administration yourself, going to them yourself. You can go to the website ssa.gov and set up an account and be able to access your estimate of Social Security benefits. Now, this is the same document that they mail out every so many years, and as you get older, they send them a little bit more frequently, but you can go in and take a look at it anytime. It's updated annually, and it pulls information from your tax return to be able to get the information that goes into this and provides the estimates of the calculation. Now, keep in mind, these are estimates that are in here. Now, if you've done this already, fantastic. If you have not, I suggest it's something you do. Like soon, like right away, like this evening would be a good time to do it. And here's why. One of the recent hacks that the bad guys have started to do is they will go in and set up somebody's Social Security account that they haven't done it already. Right? If you haven't gone on and set it up, there's no password that is unique to you. And the way you go through the process of setting it up is Social Security is, using information from credit bureaus that they pull into a system where it asks you a series of questions. And the questions are aimed at making certain that you are who you say you are. So it's going to ask you, did you live at this address? Did you have a car loan with this bank? How much is your monthly mortgage payment? Right? And, it's detailed enough that pretty much you got to be you to answer those questions. Unless, of course, you've managed to hack into one of the credit bureaus or something else and you have a dossier on somebody where you could go in, pretend you're them, and set up the My Social Security account for that person. And you'd set it up with your email, right? And the problem comes is that what they'll do is at the time that person turns 62, they'll go ahead and file for an early benefit. They'll set up a bank account where the money will go to. And by the time anybody figures out that the wrong person is getting the benefit, they're long gone. The money's long gone. Right? And you won't figure it out until probably about a year later or more when you get a notice from the IRS saying, hey, you didn't claim your Social Security benefit that you got paid last year. And you'll think to yourself, well, I didn't get a Social Security benefit last year. No, somebody else did on your account. Now, what these people are doing is stealing from the government. They're not really stealing from you, but they've created a huge headache for you because now you've got to deal with the IRS and the Social Security Administration to get this cleaned up. Now, the way to protect yourself from that is to go in and set up your account on ssa.gov, put in your information so you can lock it down with your own unique password and you'll be protected. So in terms of determining how much your benefit will be, it really kind of, it anchors on 2 key questions. First, how much you earned over your working career and the age at which you apply for benefits. So on page 2 of the Social Security benefits estimate, you'll see at the top is an estimate of what your benefits amounts are going to be. And as I said, this is updated yearly. We're looking at a sample here for Wanda Worker, and this is a PDF that the Social Security Administration puts out. And you can see up here at the top, we're talking about Wanda's retirement benefits. Wanda was born in 1960. Her full retirement age is 67. And so if she were to claim Social Security in that year based on her earnings history, she would have a monthly benefit of $1,936. Now, she could wait until age 70, and this is where the delayed credits come in, and we'll explore these in more detail in a few minutes. But that would increase the benefit amount to $2,468. Of course, she also has the option at claiming any time after age 62, but before full retirement age. This is described as claiming early. And if she claimed at the earliest possible point when she turned age 62, her benefit would be reduced from this 1986 number down to 1,376. Again, we'll look at the details of that. Also, you'll see what a disability benefit you would be entitled to, as well as benefits for your family or survivors. So how the benefits are calculated. As I mentioned, it's based on your earnings history. And what the Social Security Administration does is when you turn age 62, they take an initial calculation of this, and they look back over all of your years of work. And on page 3 of the benefits estimate, they'll have a history of all of your earnings. I know these numbers are a little tiny and you can't see them there, but for Wanda Worker here, it starts all the way back in 1976. So probably, maybe her first job when she was in college. It looks like she made about $228 that year that were subject to the Social Security tax, and the same that were subject to the Medicare tax. That's these two columns. And of course, each year, as she made more money and got out of school and got into the professional world, those numbers were growing. And what the Social Security Administration does is it goes back and it looks at all of those numbers and it makes an adjustment for inflation. $238 in, I believe that's 1976, it certainly would have more buying power than it would today. So we've got to adjust that for inflation, right? And as they do that inflation adjustment, they'll stack rank all of these, and they'll take the 35 highest years of earnings and divide that to get it down to an average indexed monthly earnings amount. That is the AIME. They take those 35 years and they use that average index monthly earnings amount and apply it to a formula to determine how much the benefit would be. Now, even though they start doing this calculation at age 62, they recalculate it each year. And one of the things that happens is there's a cost of living adjustment that will go into it. Plus, there may be changes to your earnings record if you continue to work. So taking a look at how that formula works. And this example, if we take a typical baby boomer, maybe born in 1958, and each year they had earnings that maxed out where the Social Security tax stops. Right? This year, only the first $137,000 of wages or earnings are subject to Social Security. Beyond that, they don't charge any more. So there's a maximum amount each year everybody could have. And if we did the math on that for somebody who's been in the workforce, since the age of 22, the maximum AIME would be about $10,683. So now we take that average index monthly earnings amount and apply it to the formula down here to calculate what the primary insurance amount is. That's referred to as the PIA. This is the benefit that this worker would receive at their full retirement age. Now, the formula is set up where the first $960 of this 10,000 bucks, you basically get 90 cents on the dollar. So a total of $864. And this graph over here is showing you kind of that first leg of this formula. And then it takes a bend. That's where they refer to it as having bend points. The next 4,825, you get 32 cents on the dollar for a total of $1,544. And you can see the slope of the line starts to drop a little bit. And then once we get out past this number, in this instance, the next $4,898, you're getting 15 cents on the dollar. Now, you may scratch your head and wonder why. Why is the formula this complex? Well, Social Security is designed to be an insurance program. Back when Roosevelt signed this into law, I think one of his quotes at the signing was, that no one should be subject to poverty simply because of old age or disability. This was meant to be a safety net, right? So by creating this formula with these 3 different calculations, these bend points, the program provides more value to folks at the lower income end of the spectrum than it does to people at the higher end of the income spectrum. Now, insurance, and notice we're calling this your primary insurance amount. Insurance is different than an investment. And I think sometimes people maybe get confused and they talk about Social Security and maybe they try to think of it like it should be like a retirement savings account, maybe like it's your 401k. Your 401k, you make payroll deductions into that each and every month. Your employer may match those, right? And you have an account that's growing. You invest it, and at the end, you can take that account with you. You can take all the money out at once. You can spend it out over time, right? It's your money. But that's not the way Social Security works. Social Security is providing an insurance benefit here, and that's an important distinction. So the primary insurance amount in this instance, when you total up all of these things for this example, this person at full retirement age would be entitled to a benefit of $3,142.70. The second part of this equation is around when you start to take it. So the first piece was how long you've been working and then at what age. But the very first strategy in terms of maximizing your Social Security benefit is to make certain that your earnings record is correct. So when you look back, let me go back to this slide here. When you look back on page 3, it's not uncommon for there to be errors or mistakes in these numbers, particularly if you were self-employed at some point along the line. The process that the Social Security Administration extracts this information from tax returns, it's a little bit more cumbersome for self-employed individuals than it is for somebody who's working, maybe getting a W-2. And so it's not uncommon to see mistakes in here. Because we're using an average of the highest 35 years, right, if you have a number of zeros in there that should actually have numbers, that's going to have a huge impact on the calculation. If you remember from school, or if your kids ever brought home a couple of zeros on those quizzes, they really bring down the total grade. It's hard to make an A. And so you want to check that and make certain that all of that is correct and accurate. Make certain there's no missing years. And the other thing you could do is to maximize your benefit is to keep working maybe longer. If I have a lot of years in here with low income and I'm working past age 62, 63, 64, 65, I'm taking out those lower numbers. And so that's a third opportunity within that strategy of maximizing, your earnings record here. But let's take a look at how the age factor works in terms of when you claim your Social Security benefit. So the full retirement age is the age at which Social Security says this is when you can retire and take that full primary insurance amount without any penalties. It used to be 65. They moved it out to age 66. They added in a provision where now, pardon me, if you're over, excuse me, pardon me, need to keep some water nearby here. Oh, that's empty. Oh, well, I will suffer through. If you were born 1960 or later, your full retirement age is going to be age 67. If you were born 1954 or earlier, your full retirement age is 66. And these years in between, they simply just tacked on 2 months each year until we get to age 67. So if you were born in 1956, your full retirement age is actually 66 and 4 months. That's when you could retire and take the full benefit without any penalties. But you say, wait, I could take it early. Yes, you can take it early. So let's look at what happens if you take it early. If you take it early, there is a penalty, and it's a permanent reduction in the benefit amount. And it depends on how early you take it as to what that penalty will be. So we'll just look at the example of someone with a full retirement age of 66 and somebody with a full retirement age of 67, knowing that there's also 5 other combinations in there, 66 and 2 months, et cetera. Somebody with a full retirement age of 66, they apply for Social Security early at age 62, the soonest they can get it. They're not going to get the full benefit. They're only going to get 75% of it. Or said another way, they're going to lose 25% of it as a penalty for taking it early. Now, if they took it at age 63, the penalty is a little bit less. It's only 20%, and so on. That if they took it at age 66, they get 100% of it, but at 65, they'd have to give up 6.7% of it. The numbers are a little bit different for those of us who were born after 1960. In fact, if you claim at age 62, the penalty is 30%. Now, this is a permanent penalty that it impacts how your benefits are going to be paid for the rest of your life. Now, if you should choose to retire early and you take Social Security early, and then you decide 6 months later, this was a terrible idea. I'm bored stiff. I want to go back to work, right? Or whatever the decision is, you decide that you want to turn it off. The Social Security Administration gives you that first 12 months after you claim to basically call a do-over. You can terminate the benefit. You have to give them back the money they've given you thus far, but you can reset the clock. But once you get past that 12-month, you can't suspend that benefit until you reach your full retirement age, at which point you could suspend it, and we'll talk about why you might want to do that. But if you, after that first 12 months, that penalty is going to become permanent and baked into your benefit going forward. Now, if you have questions as we go along, down on the bottom of your screen, there is the chat box, as well as a Q&A section. And my producer, Betsy, is going to be monitoring that. I'm going to stop here because I've been moving kind of quickly and just check in with Betsy. Do we have any questions so far?
We do have one question, Clark, and it actually comes at a good time because I think you just talked about this a little bit. But one of our attendees says that he's 2 months from his 62nd birthday, and his advisor here at Victory and he have determined that he should take the Social Security benefit at age 62. But he has a question about how the government pension offset affects the benefit his wife might receive when he passes.
The GPO. So the GPO really is, who has the government pension? Is it the husband in this instance or the wife?
He does not say, and so if you want to put that in the little chat box.
Can he text in? Yeah.
Yeah, the Q&A box. Francis, if you would like to go ahead and just let us know if you are the one that has this government pension offset or if it is your wife, that would be great.
Well, I can answer the question either way. Essentially, with the government pension offset, it impacts those who are receiving a retirement or a disability benefit from a federal, state, or local government based on their own work for which they did not pay into Social Security. So for the survivor, if the survivor is not receiving that government pension, it's not going to impact them. But if he is the one with the pension and he's collecting her survivor benefit, that may be actually the instance, because if he hadn't paid into Social Security, he may not have that much of a benefit. It's going to be reduced by 2/3 of the amount of the pension he's getting. So it could quite nearly eliminate it. And it won't apply if you, in certain instances, if you finished out your career in a job where you were paying into Social Security and you were in that pension system. The example of this, and some of you may be familiar with this, the school district next door in Oconee. Georgia is unique in that they allow each of the individual school districts to kind of set their rules for retirement. Well, in the Oconee School District, they've got it set up differently where they provide a more generous retirement plan benefit, but they don't pay into Social Security for the teachers. That's different than it is here in Clark County. But those teachers will participate in the Georgia Teacher Retirement System, and they're getting that government benefit, which kicks in this GPO. It also kicks in something called the windfall elimination provision. If they change jobs, and you may know people who've done this, and come over to Clark County and work in the school district here for the last 5 years of their career, they actually end up avoiding those things. That there is a way around it. But if you've worked for 30 years or more in a job where you've paid into Social Security, even if you do have a pension benefit from a government, state, or local entity, none of this is going to apply. If you worked for less than 20 years in terms of a job that paid into Social Security, then the WEP and the GPO become an issue. And there's actually, from year 20 to 30, there's kind of a scale in terms of how it impacts. But
okay, so in this case, it is his wife who's a retired school teacher. She does get zero Social Security benefit. So his question is, if he passes first and she's taking his Social Security benefit, then how would her government pension offset affect the benefit that she might receive from his passing?
Generally speaking, it's going to be reduced by 2/3 of the amount of the pension she's receiving. There is a de minimis or minimum amount it won't go below. I don't have that one at my fingertips, but we can get that information.
Okay, very good. We'll put you guys in touch after the webinar.
Terrific. Excellent.
That's our only question right now.
Do we have any other questions?
That is all right now.
Cool. Well, you see how that works. This is an interactive and engaging program. So send your questions to Betsy through the Q&A. I'll pause every now and then. Or Betsy, if you're getting overwhelmed with a lot of questions on one topic, just go ahead and throw the brakes on me and we'll stop and answer them. So we've been talking about if you claim Social Security early, you're subject to a penalty. What if you wait and you don't take it at full retirement age and you continue to work? Why would you want to do that? Well, there is a benefit to it, and that you can earn an 8% credit for each year you delay. So if we take a look again, somebody with a full retirement age of 66 and also somebody with a full retirement age of 67, for the 66-year-old, right, they can get their 100% of their benefit at age 66. That 67-year-old would actually be taking it early. But if they wait a year, they'll get 108% of it. If they wait 2 years, 116%, 3 years, 124%, 7 years out to 132%. For those of us born after 1960, it doesn't quite get as generous as it is for our older fellow baby boomers. But nonetheless, this can make a big difference, and it's a really important planning point. Oftentimes, we're looking at making certain that we're going to have cash flow in the out years of retirement. We're planning for income for 25, 30, 35 years, right? And sometimes people say, oh, I'm never going to live that long. How do you know, right? And you need to plan for the event that you may. And so this can become an important planning topic or a planning point when we're looking at the entire scope of somebody's situation. Now, a couple of reasons that this becomes important is because of how Social Security works. First of all, Social Security gets a cost of living adjustment each year. Now, they just announced on October 13th that the cost of living adjustment for 2021 benefits is going to be an increase of 1.3%. Not very exciting, right? But we are living in a very low inflationary period. Some numbers I saw the other day, some of the key things like food was up maybe 1%, energy was down 4.3%. Shelter was up just slightly, you know, all the things that factor into it, where we're fortunate in that we don't have inflation as a problem to plan for. I mean, I remember back when I was a kid, and you know, growing up in the 70s, and we had odd and even days to get gasoline, right? And you know, we had to whip inflation. Now that Jerry Ford was going to, you know, figure out a way to beat inflation by having us all wear buttons. And I had an older brother in 1979 who got his first job as a mortgage rep, selling mortgages with 18% rates. I mean, you know, and today, right, we're fighting over going 3.25, right? So it was just a much different environment. And, you know, who knows what the future holds? And we maybe go through cycles. Hopefully we don't return to a period like that. But if you were living on, you know, quote unquote, a fixed income, having something that would adjust for inflation in those periods would have been absolutely critical, and Social Security was. So the Social Security Administration, in terms of forecasting out over the intermediate term, they put out a high, medium, and low number of what they think inflation is going to be. Right now, the median number is around 2%. But let's look at what that means. You start claiming this benefit sometime in your 60s or 70s. And if we consider life expectancy, if you have a married couple, age 65, odds of one of them living to age 90 is about 50-50. Odds of one of them living to age 95 is about 1 in 4. So it's not inconceivable that somebody could possibly live a number, you know, 30 years, 35 years from retirement. In fact, it's probably fairly likely. But if we take a $2,000 benefit and we adjust that for inflation, after a 10-year period, that $2,000 benefit would be increased to nearly $2,600. After 20 years, around $3,300. 30 years, around $4,300. So that's a significant benefit, and that's unique to Social Security. The second thing is that Social Security offers income you cannot outlive. Right? Now, we'll talk about the future of Social Security, and if you're skeptical of that statement, I can understand why, but it's a government benefit, right? And the United States government, in all likelihood, is going to be around to send out those payments. So now we start to think about, what's the lifetime value of this when we factor in the inflation and we factor in that longevity, that, you know, over a period of 30 years or more, a starting benefit of $2,000 a month cumulatively could add up to, you know, over $1 million. So it's a really important part of someone's overall retirement income plan. The question of when you should apply, and there are no really good rules of thumb to say you should always do this, because quite frankly, every situation is different, and you need to really look at all of the factors that are impacting somebody and all of the assets and resources they have to draw on to come up with what's the right answer for you. But for many, it really matters more about how much your first check is from Social Security than when you get your first check, right? If my first check is potentially $2,000 compared to $1,200, you'll see the impact of these cost of living adjustments and inflation over time can be very significant. So the compounding impact of this, let's look at an example. On our graph here, on the left-hand side, we're going to measure the amount of a monthly payment. We're going to start with somebody who at full retirement age, at age 66, would be entitled to a $2,000 benefit. That would be their primary insurance amount. And we'll look at how that benefit amount would grow over time, factoring in the cost of living. So the first thing to note is their PIA amount of $2,000, if they claim early at age 62, they're going to have a 25% penalty. They're only going to get a benefit that's 75% of that. So they're getting $1,500 a month, right? Which you might say, yeah, but they're getting, you know, 4 more years of those checks. Okay, that is something to take into consideration. By the time they get to age 70, with the cost of living of adjustments, that amount has grown to $1,842. Still less than that primary insurance amount of $2,000, which would have been available if they waited until age 66. And we can watch this grow over time, that as we get to age 95, age 100, just with the cost of living adjustments, we now have a benefit amount coming in each month of just less than $4,000. Let's compare that to what if somebody waited and delayed that same $2,000 benefit and didn't start collecting until age 70. Well, the first thing is their benefit would be 132% more than what they would have got at age 66. So that starts to make up for the fact that you didn't get quite as many checks in total. And each year, as the cost of living adjustments are made, the impact of this becomes even more significant, that by the time we get out to age 95 here, where the early claimer has a benefit of almost $3,500, the person who delayed has a benefit that's, you know, gosh, what would that be? Maybe 70% more of just under $6,200. And the reason why this becomes important is that cash flow out here at 95. I mean, what do you think we're going to be spending this money on? I mean, if we're lucky, yeah, maybe we're out healthy, active, you know, playing golf. I mean, that would be fantastic, right? But in all likelihood, we're going to have to be paying bills for people to take care of us. And there's a lot of expenses that aren't going to be covered by Medicare. And so you start to think about the risk of living longer, the increasing costs that come with living longer, and then the new costs that come in towards the end of our lives. How are we going to be able to pay all those bills? And so making certain that we have adequate cash flow out there for many people is a really important part to plan for. How are we doing on questions? Any other questions come in, Betsy?
Yes, this actually relates to your slide. When you're looking at this, is there an actual formula that you use to figure out how long it would take to make up the difference of retiring at your full retirement age or just waiting until age 70?
Yep, it's often referred to as a break-even analysis. You can go online and find some, if you Google it, break-even analysis, Social Security, you can probably find some tools that will do that. Many of the financial planning tools that we work with, you know, we have those and we can share those with you. But there's a couple of things, a couple of different ways to approach it. And it all kind of depends on the assumptions that you use. And I think it takes us right to this next slide of how do you make that decision, right? So first of all, you consider health status. Now, if somebody who is terminally ill and they're 62, delaying, you know, probably not a good idea, but maybe they're not terminally ill. Maybe they have significant healthcare issues that would lead one to reasonably conclude probably not, this is not somebody who's going to live to 100 unless we find some cures for these things quickly. You look to also family history. You know, at many instances in my family, you know, my mother, on my mother's side of the family, my mom lived to 94. Her older sister lived to 98, got remarried at 88. Yeah. Their mother lived to 91. I was a late life baby. My mother was a late life baby. My grandmother was born in 1885. And you go back, I mean, we're fortunate in our family that we've got some longevity like that. And of course, you think about the healthcare that we enjoy today compared to a woman who grew up, you know, in the Victorian age, right? And what that was like, right? So chances are our life expectancies may be longer, but you need to look at the reality of that. You also need to consider, okay, do you have other sources of income? Is working longer an option? You know, for some people, maybe they've had a career where it's a lot of physical, hard work, and they're at a point where their bodies just can't do it anymore, and they need to replace that income somehow, some way. Other people, maybe they're in careers where, you know, it's more about, you know, it's less about the physical work, and maybe even they have a passion for what they do. So working longer, you know, maybe has appeal to it. And then you got to think about survivor needs. I mean, that was a very keen question that our participant earlier asked, is you got to look at this not just from the standpoint of, you know, is it giving me enough money, but you know, how is this going to impact my survivor? And in our family, my wife has spent many years, you know, working at home, taking care of the kids. When she was in the workforce, it was pursuing things that she loved, right? She worked for, you know, as the middle school receptionist when our kids were in school, and, you know, had a ball, loved it. She's right now, she's running a little retail store downtown, store called Archer Paper. I'll put in a plug for it. But she's having a ball. She loves it. These are not, you know, six-figure high-paying jobs. And when we look at her earnings history, there's going to be a number of years there with zeros because she was at home, you know, taking care of the kids. And so what's really important for the two of us as we plan is that I'm maximizing the survivor benefit that she's likely to receive. Because the statistics, you know, hold out that women outlive men. And there's a joke about that, but we don't have to go there. And so it's really important that the way I approach this equation is about maximizing the benefit for her. But your situation may be different. And so, but doing the break-even analysis, yeah, it's pretty straightforward mathematical equation. And in most instances, it works out to around age 83, 84, something like that. That somebody says, well, I'm never going to live past age 83. How do you know, right? And once you get past that, you make it past that break even, then you're really accelerating the benefit for yourself. But if you have illnesses, if you don't have, you know, life expectancy in your family history and you need the income, it may be more important that you get the cash flow sooner. Any other questions?
That's all we have right now.
Fantastic. So some key points to remember out of this section we just covered. If you apply early, your benefit is going to start lower and it's going to stay lower for life. The COLAs, or the cost of living adjustments, they magnify the impact of whether you're claiming early or claiming later. And the longer you live, the more beneficial it is to delay. And this decision impacts your survivor benefits as well. So delaying the benefits may give the surviving spouse more income. So there's one other thing that can come into this, and in particular, this applies only if you are taking Social Security benefits before full retirement age. And it's the earnings test. So Social Security says, yeah, you can claim early at age 62, but you're retiring, right? That means you're not going to work anymore, right? Right? This isn't just to put some extra cash in your pocket while you continue to work. So if you retire before full retirement age, there is this earnings test. And you can work part-time. That's not a problem. You know, and in fact, I've got lots of friends that I work with that, you know, after, you know, 35 years in the corporate world, they retired early at age 62. And well, one friend of mine, in order to get health insurance, and she had been, you know, senior management level at a bank up in Boston. She ran the learning and development group and retired down to Florida. And one of the challenges of retiring early is think about how you're going to pay for health insurance. Well, she got a part-time teller job at one of the big 4 banks where she works like 3 days a week. She's probably making maybe $11,000, $12,000 a year, maybe a little bit more than that, but it came with health insurance. So she was ecstatic. She was ecstatic to be in the bank, but downstairs in the lobby working with the customers and not having to work with, the corporate politics that, that go on upstairs. And she's having a ball doing it. She just loves it. But you can work part-time. It's if you're staying, fully employed, where your income is above, for 2020, $18,240. For every $2 over that, they're going to take back $1 of your Social Security benefits. Now, the problem is most people don't figure this out until after it's happened, right? You're doing your taxes and you realized, oh my goodness, I made $30,000 last year. And that information goes over to Social Security, and Social Security says, you retired before full retirement age and you made $12,000 more than, what the earnings test is. So we're going to have to take back $6,000 in benefits. And how do you suppose they do that? Do you think they take it out a little bit at a time? No, they just turn off your benefits. And so you stop getting checks until they've got their $6,000 back. So it could be quite disruptive. Now you could plan ahead, right? No reason to turn down work, right? Because I'll explain to you in a minute, this really isn't, it's not that they're taking this away from you. The money, it comes back into the formula once you reach full retirement age. But if you had an opportunity come up, a consulting opportunity or something, and it was a way to make $40,000, $50,000, you say, okay, I know I'm going to have this. Contact Social Security first and let them know, and then they can make an adjustment to the benefit amount, prospectively, as opposed to having to figure it out retrospectively. So you can plan around it. But the earnings test shouldn't discourage you from working. It's just kind of a fact of life of how it works. And when I say that it doesn't, it's not like they take it away from you. In that example I used a little bit earlier, where somebody made $30,000 or $12,000 more, so they're going to take back $6,000. If we assume the primary insurance benefit was $2,000 a month, they're basically taking 3 months of benefit away. And so what it has the impact of doing is, if you started at 62, they're going to recalculate it and say, oh, you actually started at 62 in 3 months. So it kind of pushes that back, and it will impact the formula, and you'll get those dollars back in the benefit calculation once you reach full retirement age. Any questions there?
Let's see. We do have one question. Can you touch on the windfall elimination provision?
So this is, again, if you were working in a job where you weren't paying into the Social Security system, and you realize there's two parts to that, right? The employer pays 6.2 or 6.3% of the payroll tax, and you pay 6.3. And then there's the Medicare on top of that makes up the FICA. So if you're in a job, like I said earlier, an example would be over in a Oconee School District where you're not paying into it. The first bend point, I go all the way back to this first bend point of 90 cents on the dollar gets reduced to as low as 40 cents on the dollar. And that's if you have less than 20 years of earnings history paying into Social Security. So we go back here to this. If you've got, a bunch of zeros over here under the Social Security column, and less than 20, then this first bend point is going to get reduced from 90 cents on the dollar to 40 cents on the dollar. So that's a little bit more than half. $960, let's say it cuts it down by $600. We can give you a more precise number if we had everything, we could put it into the tool. Now, for every year, like if you did have 20 years of work, right? If you had 21 years of work, it reduces it, let's see, substantially or anything. I'm looking at a table here for, yeah, For 21 years, it reduces it to 45 cents on the dollar. For 22 years, it reduces it to 50 cents on the dollar. 23 years, 55 cents on the dollar, and so on until you get to, if you had 30 years, going back to this table here, if you had 30 numbers here, right, then it wouldn't have any impact on you. But it's less than 30, and this is going to get reduced to somewhere between 90 cents or 40 cents and 85 cents. It's 5 cent increments over those 20 years, 10-year period rather. It's not a huge impact. Well, it could be. It all depends on what your average index monthly earnings are. The GPO is the flip side of it, where, if I'm the worker that didn't pay into Social Security, it impacts what I'm getting as a survivor benefit. Okay. The WEP is I've got some Social Security, right? Or and what would be the reduction of that? And the Social Security could be the spousal benefit that's going to be reduced. Other questions?
That's it for right now, Clark.
Excellent. So we left off.
I think we're on number 17.
Yep. Excellent. So strategy number 2 for maximizing your Social Security benefits. You need to consider the following. First, what are your income needs, both now and in the future? What are your life expectancy expectations? And in terms of spousal protection, what are life expectancy, what is that likely to look like? So it's a multi-dimensional decisioning process. So speaking of spouses, let's talk about how the spousal benefit works. I used myself as an example, and my wife, Stacy. Stacy has got lots of zeros and lots of low numbers. So if you look at her Social Security benefit on her own work record, it's very small, right? And when they built Social Security, it was not uncommon that you had, one income family with, in many instances, the homemaker being mom who stayed home to raise the kids. And so they baked into it this provision to provide a benefit for that non-working spouse. And a good rule of thumb, and I said earlier, there are no good rules of thumb, but generally speaking, the spousal benefit is going to be equal to about 50% of what the working spouse's benefit is, right? Now, if Stacy had enough of an earnings record where she got a benefit that was more than 50%, then she'd get her own benefit, right? And wouldn't get, she wouldn't claim the spousal benefit. You don't get both of them. She doesn't get her benefit plus then 50% of mine. It's an either or. So if her benefit is less than 50% of mine, it's going to be 50% of mine. Otherwise, it's just going to be her benefit that she would claim. So some of the rules in here, the spouse of a worker entitled to Social Security may claim this spousal benefit. So I'm entitled to it. That makes her entitled to it. The benefit is generally 50%. The primary spouse, in order for her to start collecting, I need to have already filed, right? She could file on her own record. And in a lot of instances, it makes sense that when the spouse that has the lower Social Security benefit at full retirement age, they just go ahead and file on their own record at full retirement age. And the higher earning spouse with the higher benefit may delay theirs until age 70. That's oftentimes a common situation that we'll see. But in order to file and get the spousal benefit, the working spouse has to have filed as well. The spouse must be at least 62 in order to get reduced benefits. So in this instance, that means Stacy would need to be at least 62 to file. Now you'll notice the penalty for filing early under a spousal benefit is more than that 25% penalty. It's 35%. So we really got to look carefully as to whether or not this makes sense or not. The spousal benefit is going to be based on the worker's primary insurance amount, not their actual benefit. So, you know, if we wait until I'm 70 and I've got, you know, 24% more of a benefit coming, the spousal benefit's not going to be based on that. It's going to be based on what my primary insurance amount was. There's no delayed credits for the spousal benefit. So there's no reason why she shouldn't claim if I've already claimed. And the marriage requirement here to qualify as a spouse is that you were married for at least 1 year. So the survivor benefits is essentially whatever the benefit of the working spouse is that they are earning upon their death. The spouse is going to, let's see, am I on the wrong slide? I'm speaking to the wrong slide. What if spouse is also entitled? Actually, I'm sorry. I jumped ahead. I'm thinking about the next slide, but this slide is just covering what I mentioned a moment ago. So in the instance, if Stacy had her own benefit she's entitled to, she would receive that first, right? And then the way they actually calculate this, that spousal benefit, it's what's the difference between that and 50% of my benefit. But if her benefit's more than 50%, spousal benefit doesn't even come into the equation. So in terms of figuring this out, strategy number 3, it's really important to coordinate the spousal benefit and the claiming strategy here. And it's all going to depend on really what's most important to you in terms of your plan. Is maximizing lifetime benefits a priority, in which case taking a lower cash flow now or less income now in order to get more income later may be the way to go. The earliest the benefits come in. If you need the cash coming in, that means you're going to get more money now, less later. If that's a priority, then there's a certain way to go. And then there's some hybrid strategies, much like I mentioned a few minutes ago, where maybe it makes sense for, you know, the lower earning spouse to claim their benefit at full retirement age, you know, and then once their spouse starts to claim at age 70, they flip it over to a spousal benefit at that point. So rules for survivor benefits. My mind had jumped ahead. So the amount of the survivor benefit depends on 2 things. First, when the deceased spouse originally claimed their benefit, the original benefit amount, and then when the widow or widower claims their survivor benefit. And this could be important if, you know, when we're getting into the situation of looking at the potential penalty. So if the deceased spouse started at age 62, that impact is going to carry through in terms of the survivor benefit. And the same is true in terms of when the widow or widower actually claims the benefit. If they claim before full retirement age, now you've got another penalty situation that could work into this. But some of the key points to remember out of this. First is, upon the death of a Social Security recipient, the benefits stop. Right? And the surviving spouse is entitled to a benefit that is equal to what that deceased spouse benefit was at the time of their death. Now, if it's less than what their own benefit is, they're not going to claim it, right? But if it's more than their own benefit, then they're going to want to claim that survivor benefit. The widow or widower will receive the full survivor benefit if they claim it at their full retirement age or later. Their own benefit will stop, so you don't get both. Right? You're going to get the larger of. And if the widow or widower's own retirement benefit is higher, they're going to keep their own benefit and not file for the survivor benefit. Divorced spouse benefits work pretty much the same with a couple of caveats in here. So in terms of a spousal benefit for a divorced spouse, if they were married at least 10 years, and the claiming the divorced spouse is currently unmarried, right? And the ex-spouse is at least age 62, then they can file. And if the ex-spouse has already filed, fantastic. But if the divorce is more than 2 years old, you don't even have to worry as to whether or not that ex-spouse has filed. The divorced spouse can go ahead and file. Now, what's interesting about this, remember, Social Security is an insurance program. It's not an investment program. So there's insurance benefits to people that are entitled to them. So, you know, if you got a car wreck and you got 4 people in the car, and you have liability protection for medical of 50,000 or 100,000, that's per person in the car, right? So if you have a marriage car wreck, but there are instances where you find people who had many marriages over their lifetime, and if you had a serial marrier who married every 10 years, you might have 4 or 5 spouses, all of whom would be entitled to a divorced spouse benefit. I mean, and that's a lot of money that would add up. And what's interesting is it doesn't impact the total amount that would go out. Everybody would get what they were entitled to, including the ex-spouse who had all those marriages and their current spouse. So it has no impact on that current marriage or the remarriage, anything like that. Everybody gets what they were entitled to. Now, if the divorced spouse is married, then they're married, they're not able to do that. It's only if they're single. But if they get married and then become single again, they would be entitled to that. Now, the divorced spouse survivor benefit is same as the survivor benefit for a married spouse. The marriage, again, needs to have lasted at least 10 years, and you're currently unmarried, or the remarriage took place after age 60. So if you have any friends out there that are dating and they're 59 and they're thinking of getting married, and their ex-spouse was making a whole bunch of money and a really big Social Security benefit, they should wait until after they turn 60. Do we have any questions around this?
I don't see any questions relating to this subject yet. I did remember a question from the 10 a.m. webinar regarding this. So if the primary spouse or ex-spouse passes away before they claim that benefit, is the divorced spouse able to file that survivorship claim?
Yes.
Okay.
Yeah. And there'll be a calculation that goes into figuring out what it should be, right? But yes, if they would have been entitled to a benefit. So if we look at strategy 4 here for maximizing Social Security benefits, it's minimizing the taxation on Social Security benefits themselves. And this area gets kind of complex, and there's more detail to it than we have time for this evening. But really, the application of this is just paying close attention to things like your investments and the characterization of the income from your investments and the alternatives that you have and the different types of accounts that you can use, and maximizing the tax advantages to those. Municipal bonds might be one idea. You think, well, those are tax-free, right? And fantastic. Social Security figured that out, and they actually make you add in municipal bond income into the equation. And at a certain level, 50% of your Social Security benefit will be subject to income tax. And that's when you hit, roughly on a joint return, somewhere around $45,000 of income. And then at the next tier, 85% of your Social Security is subject to income tax. And it's a bit of a complex formula. Fortunately, the tools that are available to do planning for this allow you to anticipate that. And there's, in fact, a kind of about a $6,000 window of income that is referred to as the tax torpedo, is that if you eclipse that, it kicks a certain amount of your Social Security into being taxed, and the net marginal rate or impact on that amount of money, it's like 85%, or it's huge. And so it's just one of those things to keep an eye on in terms of recognizing when you're going to take income, if you have the ability to shift income from one year to the next, to be able to balance that. Anticipating the required minimum distributions that are going to have to come out of your qualified retirement accounts, your IRAs. that can have an impact on the taxation of your Social Security. So considering maybe drawing some of that down so that you don't have quite as large a balance in those, and even looking at strategies for converting those from the traditional IRA or traditional qualified retirement plans into Roth accounts, because as that money comes out, that's totally tax-free. That doesn't get figured into the equation of the taxability of your Social Security. Delaying Social Security, less years of exposing your Social Security to taxation, looking at ways you can be able to reduce expenses, to maybe adopt a simpler lifestyle, and then just continuing to keep an eye on it and manage it throughout retirement. But it's an important consideration to maximize what you're getting out of Social Security. Strategy 5 is coordinating this with all of the other things that you have going on. It's really difficult to try and make the right decision in isolation. A question that came up on a previous webinar, somebody asked, well, where do I go to get answers? And you can go to the Social Security Administration, and they're very helpful. They're very nice, but they're trained to help somebody figure out how to get the most amount of money today. They're not trained, nor do they have time or inclination to ask a whole lot of questions around the rest of your situation to try and figure out how this is going to fit in to your overall plan. So working with an advisory firm, working with a planning firm that can help you think through this, and at the very least, thinking through it yourself. What do you have in the way of pensions that are coming in? How your strategy for integrating that. Pardon me, I promise it's not COVID, it's allergies. And by the way, we're safe here. I could wear a mask if you'd like. IRAs, 401ks, your strategies for drawing down on those. The impact of the required minimum distributions, how you've got your overall investment portfolio structure to be able to draw income out of that. Your intention for work. This next chapter of your life, when you think about retirement, and there's a great book called Your Encore Career. And it's put together by an organization called Encore.org, which is somewhat of a loose affiliation of counselors and coaches and advisors and people working with folks going through that transition into retirement. And it's a good read, and it's got a lot of worksheets and tools in it. And if you remember when we were all in school, getting out of school and visiting with career counselors, there was that book they had, What Color is Your Parachute, right? Try and figure out what you want to be when you grow up. This is kind of like that book for what do you want to be when you retire? Finding purpose, finding meaning, that all goes into well-being, having connectivity, having engagement with others. So, that work may be here in the community, volunteering, that work may be starting a business, that work may be teaching or mentoring. There's so many things you could do, but understanding, how that fits into your whole plan and what it is you desire to do. So let's talk a little bit in our last few minutes here about the future of Social Security. The trust fund, as they refer to it, at the end of 2018 had $2.895 trillion in it. And looking at the results from 2019, total income came in, total expenditures, actually wasn't too bad of a year, right? Kind of held its own. But the problem is the trend line. And so if we come over here and we look at this graph, and starting back in 2000, we see this blue line here, which is the benefit payments going out, all right? And this red line here is the cash flow coming in. And at about 2009 is where things eclipsed each other, right? And we came into this period where we had more money going out than was going in. And as you project this out, if we get to 2034 under the current scenario and we make no adjustments, we're only going to have about 80% of the benefits or the cash flow coming in to pay out to meet the benefits. So said another way, Social Security Administration is going to have to cut everything by 20%, right? So 2034 could be the year that everybody gets a 20% pay cut on Social Security, which makes some of those other decisions we were thinking about maybe even more important, right? Because if you claim earlier at 62 and you've got a smaller amount, now you're getting 20% less of that versus having waited, you get a larger amount, 20% less. Now, think about the practicality of this. What congressman, what senator really wants to get on an airplane and go home to their district in 2034 after everybody has just had a 20% pay cut in Social Security? I mean, the gray-haired people in masses with pitchforks and torches, I can't imagine that they would actually let that happen. But I'm an optimist. But here's the kinds of things that they talk about as maybe ways to fix it. Right now, there's some legislature floating around, the Social Security 2100 Act. Don't know if this gets enacted, but look at the things that they're thinking of. First, some of these things at the top of this list would actually increase benefits. That first bend point we were looking at, where you got 90 cents on the dollar for the first $960, they'd increase that to 93 cents. Well, that's obviously going to be beneficial to people in lower incomes. They're looking at maybe adjusting the way that CPI is, or the cost of living is calculated, and changing to a different index that would probably increase those cost of living adjustments by maybe 0.2%. Down here in the bottom is where we look at the ways for how they think they would want to pay for it. And so one of them that we've heard about in the news is the idea that, right now, wages up to $137,000 are subject to Social Security tax, right? Anything above that, you're not paying Social Security on. Well, they would bring in kind of this new tier up above so that wages above $400,000 would be subject to the Social Security tax, right? And that's the whole idea, taxing rich people, and that's easy to sell, that whole deal. But they would indeed, give those folks who are having to pay more into the system, a greater credit to get an even greater benefit. And then the other thing they're talking about is increasing the payroll tax from 12.4%, that's the total amount between what the employer pays and the employee pays. And if you're self-employed, you know that you pay that whole thing yourself, but increasing that up to 14.8% over a 22-year period. So gradually increasing that. And this graph over here shows what they expect the impact would be. So, this black line here is the trust fund, the whole system crashing out in 2034. The proposal here, actually, we go through somewhat of an S curve, but by the time we got out to the end of the century, we would be in a much better position. Have no idea if this is the solution they come up with. Other things they've talked about is continuing to push that full retirement age out. For our kids, it may be 68, 69, 70. Who knows? But my instinct, my gut tells me it's probably something that they figure out a way to address rather than just let the clock run out on it and have everybody take a 20% haircut. Other questions? How are we doing?
We have no other questions right now. And I know that everybody who's on here is a current client. So you all are welcome to follow up with your advisor or directly with Clark, and he can give you his email address. You're also welcome to email me. I sent out some documents earlier to go along with this webinar. And so you can just reply to that email if you like, and I can get your question to Clark or to your advisor.
Terrific. Yeah, I would point you to your advisor. I'm happy to answer questions. This is our passion, as you know, working with us and working with our firm. And we certainly would love to have the opportunity to continue to help others in the community. So, as you see these webinars come up in the news feed and Facebook, or you get the emails, please share them. We're happy to have people join. And for me personally, if in some small way I can help somebody to be able to make a better decision that's going to improve their life, regardless of whether or not they ever become a client, it brings me joy to be able to do that. And this has brought me some joy this evening. I hope the information has been helpful for you. We look forward to the opportunity to continue to serve you. And I thank my producer, Betsy. You did an awesome job tonight, and look forward to the opportunity to work with you all again in the future. Thank you very much.